Hello, welcome back everybody. This is your host Andre Rivers, the founder of RIFL Corp, and welcome back to our online sessions of Blockchain University. Our previous class we went over the blockchain and what exactly the blockchain consists of and the functions of the blockchain, and we learned a little bit about what was beneath the functions behind bitcoins and cryptocurrencies, and we also spoke briefly about smart contracts and how they were parallel to the blockchain. Today we're going to go in deeper into the decentralized nature of cryptocurrencies and Bitcoin versus altcoins. We're also going to talk about blockchains versus smart contracts. And we're also going to go a little bit about the statistical makeup of cryptocurrencies and blockchains and how we basically accumulate the price and basically the numbers aspect of it. How do we get the circulating supply and the max supply and the market cap of that? So first I'm going to do a quick recap of what we spoke about previously, which was blockchain. Blockchain and decentralized. Decentralized ledger. Miners. Secure. Alright, so we're going to discuss a little bit about the decentralized ledger and go over a recap of what that is. A decentralized ledger is, everybody knows what the ledger is. It's something that keeps track of records of, in particular, when we discuss Bitcoin and cryptocurrencies, we want to talk about financial records. So a decentralized ledger is something that keeps track of all of the transaction of all of the records, but it's not centralized. So there's not one person managing it or one entity managing it. It's a decentralized ledger or distributed ledger. So everybody has a copy of the ledger, which makes it more secure. And the function of miners, when we're talking about blockchain, miners are the ones who basically publish the records to the blockchain. They create new blocks. So the miners of Bitcoin and other cryptocurrencies, they create new assets, or they create new blocks of that chain. So they will create more Bitcoin, they will create more cryptocurrencies, and how they do that is by guessing the random key that goes with the transaction, solving the transactions, and then publishing it to everybody's ledger. So that, again, the decentralized or distributed ledger, they publish it to the distributed ledger network, and everybody has that ledger from the miner. And what happens is the miner receives a financial reward, which is the creation of the block or the creation of that other cryptocurrency. That's a financial reward the miner receives for guessing the key and posting the transaction. And we also discussed the security aspect of it and why it's secure. Because it's decentralized nature, you have to basically finesse so many different people. So many different people are on this network because it's distributed. The ledger is distributed. You would have to change so many different ledgers in order to adjust the nature of the ledger. So therefore, to make myself a little bit more clear, it's very difficult to basically disrupt or hack into the ledger because it's decentralized or it's distributed. It's hard to hack into everybody's space if everybody has different records. Well, everybody has a different function for those records. So the fact that they're distributed, it makes it pretty much close to impossible to hack into that, you know. So I'm going to speak a little bit more about the decentralized nature of cryptocurrencies, and we're going to also discuss what Bitcoin is. First, I'm going to go and we're going to look up the white paper of Satoshi Nakamoto and what he basically created, which was Bitcoin. All right, just one moment. right, and here is the white paper for Bitcoin, which is the first cryptocurrency, and it's basically the digital gold, or how everything that is of the crypto world is basically backed by the original crypto at the moment, which is Bitcoin. So Satoshi Nakamoto, he was a character. He's very cryptic. Nobody really knows who it is. He doesn't have a significant identity. But his name was Satoshi Nakamoto, and he created the Bitcoin white paper back in 2008. But about a year and a half, no, 2009, the Bitcoin white paper was published, but it was about a year and a half of development of the Bitcoin blockchain before that, before it was actually published. And so here it is. I'm not going to actually go through the entire white paper because it's kind of complex and it won't really help. But they go over a lot of the stuff that we discussed in our previous lesson regarding how the blockchains, or how the blocks on the Bitcoin blockchain are created, and how that they're public transactions, but everybody has a record of that distributed ledger. So I'm going to just read the abstract first, and then you guys will get a good idea of what exactly Satoshi Nakamoto meant when he created this this new form of digital money, because there were many attempts to create digital money back in the 90s and the early 2000s, but this was the first digital currency that was actually decentralized, because they realized that with the centralized currencies, they can be easily manipulated or easily controlled. When you create a decentralized currency, it basically expanded to deeper today than what it was actually intended for, because now that we realize the power of the blockchain, it's deeper than just being for financial transactions. We understand that it can hold so many different things and empower so many different things of our society. So here's the abstract. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. So the whole idea of Bitcoin was to basically cut out the middleman for financial transactions, okay? Digital signatures provide part of the solution, but the main benefits are lost if a trusted third party is still required to prevent double spending. And they're discussing that is in regards as to that's the main function of it, is to stop the double spending. If everybody has a financial record, or everybody has a copy of the ledger, they'll all have records of what everybody is able to spend, and it'll be all confirmed throughout that blockchain. But if it's a centralized ledger, then one person is in control of all of that, okay? All right. So the network timestamps transactions by hashing them into an ongoing chain of hash-based proof of work, forming a record that cannot be changed without redoing the proof of work. The longest chain not only serves as proof of the sequence of events witnessed, but proof that it came from the largest pool of CPU power. As long as a majority of computer power is controlled by nodes that are not cooperating to attack the network, they'll generate the longest chain and outspace attackers. The network itself requires minimal structure. Messages are broadcast on a best effort basis, and nodes can leave and rejoin the network at will, accepting the longest proof of work chain as a proof of what happened while they were gone. So that last part basically discussed of how you basically have to be confirmed to add to the chain, and the longest part of the chain, or the remaining part of the chain, the longest chain basically serves as proof of the sequence of events witnessed. So everything that happened before that is added to the next part of the chain. All right. So that was the whole purpose of Bitcoin, was to basically be created to be that decentralized financial network that'll basically help us cut out the middleman, which is the financial institutions and the people who didn't have our best interest at heart. Okay. So I'll go back to our pad. And so when you really think about it, Bitcoin as a decentralized network of peers which keep a consensus about accounts and balances is more of a currency than the numbers that you see in your bank account. What are these numbers more than entries in a database? A database which can be changed by people who you don't see and by rules that you don't know. So cryptocurrency or Bitcoin would be in reality more of a currency than what we're currently using, which is the monetary system or the fiat system, which is basically ran by political groups. And I'll go over the three different forms of money. The initial form of money or currency was commodities. And everybody knows what commodities are. Commodities would be gold, silver, bronze, oil, all things that we basically used in the beginning of times to be a form of currency. After commodities, it was political back money. So the political back money is what we would be using now, which is different currencies that are backed by countries, are backed by nations, are backed by governments. And these are all basically not really stored value, but more so currencies, which are the power is within debt and the power is within the function of the nation that's backing that currency. So we have the US dollar, the euro, the lira, the yen, the pound. All of those would be political backed currencies, and currencies that are basically backed by nations and have no real ulterior value besides the faith that we put in it because the nation is in back of it. And the last one, which I believe is going to be the final form of currency, is math. Simple. And this is what would be going to what we're going towards the future, in the future, which is the financial aspect of digital money or digital currency, which is backed by pure mathematics. It's backed by, the more scarce it gets, the more value it is, the more valuable it becomes, and which is different with the political money, because the political money can be inflated. The political money can basically be created out of thin air, whereas with mathematics, digital commodities or digital currencies, they have basically they can run out. You can't inflate digital money, so it's all backed by mathematics, which is easier to be backed by. It's easier to believe in mathematics than to believe in a government system or somebody having faith in the value, creating their own value out of what we're supposed to be using as currency. So that's the main thing, and that's going to be the future. Ultimately would be those commodities where they're backed by mathematics, and that's what I believe. And it just logically makes sense that these are going to be, well, that digital money backed by mathematics is going to be the future. So we all know about the problems with our current fiat currency as far as the inflation and how our dollar's not really worth. It's basically depleting yearly. From the inception of the dollar, it's worth around 98% less than when it was initially created. Just think about what you could buy for $1 back in the 60s or 70s or even the 40s and 30s, and think about what it's worth now. So $1 is basically inflated. It's worth way less, when it's supposed to actually function in the reverse, where the more scarce it is or the more people are using it, it's supposed to actually increase in value rather than decrease in value, when that's in fact what it has been happening. Alright. And I'm also going to discuss the transactional properties of the blockchain and why I believe, well, not why I believe, but why the whole community believes that these are components that is going to make this the future. And the first is going to be that the transactions are irreversible. I think I'm spelling this wrong. Yep. Irreversible. So after a confirmation, a transaction can't be reversed. So once it's confirmed by everybody on the blockchain, a transaction cannot be reversed. It cannot be messed with by nobody. And that nobody means literally nobody. Not you, not the bank, not the president of the United States, not Satoshi, not any miners, nobody. If you send money, you send it, period. No one can help you. If you sent your funds to a scammer or if a hacker stole them from your computer, there's nothing that can be done with it. It's irreversible. So that is the main component of the blockchain. If you are able to send the transaction is irreversible because it's confirmed on everybody in the whole network's ledger. It's confirmed on that ledger, so then it goes through and it adjusts on everybody's ledger. There is nothing you can do to reverse it. Is basically everything you do as far as getting transactions on the blockchain is permanent, and you'll always have a completed record of that. And the second is this pseudonymous. Oh, one moment, just hit that again. Pseudonymous. It's a tough word. Clean this up a little bit. Sorry about that, guy. And that means neither transactions nor accounts are connected to real-world identities. You receive bitcoins on things called addresses, which are randomly seeming chains of around 30 characters. While it is usually possible to analyze the transaction flow, it is not necessarily possible to connect the real-world identities of users with those addresses. So, although we can see the transactions of everybody on the blockchain, it's pseudonymous, so therefore your identity is literally a 30-character address. It doesn't have a name. It doesn't say Andre Rivers on my account. I have my personal key. I have my private key, and my private key is used to open the blockchain so that I can see everything, but the public key is used that you can send anything to. So the pseudonymous, which means that although people can see that it exists on the blockchain, there is no actual identity to each chain, okay? And the third part is it's fast and global. And the transactions on the blockchain are propagated nearly instantly in the network and are confirmed in a couple of minutes. There are many different cryptocurrencies that are probably faster than the original Bitcoin, which is our digital gold, but all cryptocurrencies usually are faster as far as transactions than any type of bank wiring system or wiring network or direct deposit network. We're talking about things that are confirmed in transaction and from a couple of minutes to probably the most 45 minutes to an hour. And we're talking about people sending millions and millions and millions of dollars in value, and it's taking minutes rather than taking multiple days. And since they happen in the global network of computers, they are completely indifferent of your physical location. It doesn't matter if I send Bitcoin to my neighbor or somewhere on the other side of the world. It usually takes around the same time because it's all about being on the network. It's not your location, okay? So there are no middlemen or barriers that can slow down your transaction or stop your transaction from getting where it's going. And the last point, well, not the last point, the second to last point is that it's secure. And with security, cryptocurrency, like I mentioned before, they're locked in a public key cryptography system, and that's where the name even comes from as far as cryptocurrencies, because it's locked by cryptography, and only the owner of the private key can send cryptocurrency. And strong cryptography and the magic of big numbers make it impossible to break this scheme. A Bitcoin address is pretty much more secure than Fort Knox. you have the chance of being struck by lightning before you have the chance of your private key or your public key being infiltrated on the blockchain, okay? And the last one is permissionless. Alright, and you don't have to ask anybody to use cryptocurrency. It's just a software that anybody can download for free. After you've installed it, you can receive and send Bitcoin or other cryptocurrencies, and no one can prevent you. There is no gatekeeper. There is no middleman, and that's the most prominent aspect of the blockchain, Bitcoin, and cryptocurrencies, is that it's permissionless. There is decentralized, permissionless, and nobody can stop you from accessing it or using it, and nobody can access what you have stored or have records of what you stored. They'll have records of your transactions that you made, but not of what you stored or what your identity is, you know? So, okay. And now I'll delete this. And we're also going to discuss what the monetary properties of cryptocurrencies are. Okay. I'm just erasing all of this stuff. Damn. Hold up, wait a minute. Alright, and the monetary property of cryptocurrencies, number one, is there's a controlled supply. So like I spoke about before, where with our current money, the political money, it can be inflated, it can be increased. The monetary supply is basically controlled by an entity. So there is no fixed monetary supply. But with cryptocurrencies and Bitcoin and blockchain, there is a controlled supply, and most cryptocurrencies limit the supply of the tokens. In Bitcoin, the supply decreases in time and will reach its final number somewhere around the year 2140. All cryptocurrencies control the supply of a token by a schedule written in code. This means that the monetary supply of a cryptocurrency in every given moment in the future can be roughly calculated today. There is no surprise, so there is no middle entity who controls the value or the amount that's in the supply for our monetary system. It's all basically being able to be predicted because there is a fixed, controlled supply. All right, and the second part is that there's no debt. No debt. But fair. All right, and as we all know, the fiat money that we have on your bank account is created by debt, and the numbers you see on your ledger represents nothing but debts. It's a system of IOUs. Cryptocurrencies don't represent debts; they just represent themselves. They are as money as hard as coins of gold. So there is, like I mentioned before, with the controlled supply, there is nobody controlling the supply of the money, so there is no debt created out of it. It's basically like a commodity as a currency, where there is a fixed supply of it and it's not created out of debt. Once you have it, you have it. The more scarce it gets, the more expensive it gets, rather than the more scarce it gets, you can basically inflate it and increase the supply of it. No, the more scarce it gets, the more scarce it gets. So to understand the revolutionary impact of cryptocurrencies, you need to consider both properties. Bitcoin as a permissionless and irreversible and pseudonymous means of payment is an attack on the control of banks and governments over the monetary transactions of their citizens. You can't hinder someone to use Bitcoin. You can't prohibit someone to accept the payment. You can't undo a transaction. As money with a limited circulation supply that is not changeable by a government, a bank, or any other central institution, cryptocurrencies attack the scope of the monetary policy. They take away the control central banks take on inflation or deflation by manipulating the currency supply. All right. So now that we discussed the components of cryptocurrencies and the blockchain and what makes them significant and what makes them different from our current fiat currency, we're going to take a look into the main component of cryptocurrencies, which is the digital gold blockchain, and we're going to square that up versus what we call or deem as altcoins, which is a term that you may not be familiar with. So just let me clear up this board one moment. All right. Here we are. All right. So first, Bitcoin, digital gold. So I want you to, my analogy for Bitcoin versus the altcoins is Bitcoin is the digital gold. So just think about before we created our current fiat system or our political money system. Think about the gold rush when gold, oil, those type of commodities were the power. And based on the power of who had the gold was backing the American currency or the euro or the pound. Our original currency was backed by gold. And then once they took us off the gold standard, I want to say back in 1974, that's when we were basically just backed by politics and controlled by the central banking system. But before that, all of the money was backed by gold. So that's the same with Bitcoin. Since Bitcoin is the first cryptocurrency, it is the original cryptocurrency. It is thought of as digital gold or a commodity. Now, altcoins. Altcoins is literally any coin that has a function that's not Bitcoin. That's funny. But yeah, that's literally what altcoin is. Altcoins are anything that isn't Bitcoin. So think of Bitcoin as being gold. Altcoins would be all of the other things that would go on top of that, or which was created off of the idea of Bitcoin and cryptocurrencies. So there's a lot of different things that have their own blockchains that focus on speed, focused on discreteness or privacy. There's a lot of different coins, and we're going to go into the choices of coins and what the power of different projects are in my more advanced class. But during this class, we're also going to go over just taking a look at the different type of coins, especially the different type of altcoins. And we're also going to discuss that currently now. Actually, let's go to a website that I like to look at called CoinMarketCap. Just one moment. And here's CoinMarketCap. As we can see, the first and most powerful coin is Bitcoin. The second, Ethereum. Third, XRP. Fourth, Bitcoin Cash. EOS, Stellar, Litecoin, Cardano, Tether, and Monero is our current top 10. And let's look at the market cap is around $205 billion right now. And the market cap of Bitcoin in particular is $110 billion. So Bitcoin is Bitcoin. All of these other coins, let's see how many coins there are. There's actually 2,094 different cryptocurrencies. So there's 2,093 altcoins versus Bitcoin. And the number 2 altcoin at the moment as of today, which is fall of 2018, is Ethereum at the moment. And this is going to lead us into our next discussion, which is what the blockchain is versus smart contracts. Because when we discuss smart contracts a little bit in our previous lesson, but here is an actual coin that uses smart contracts, and it is actually the first cryptocurrency that did not use the blockchain, and it used a thing called smart contracts. So let me go back to the pad and I'll show you guys the difference between big blockchain and smart contracts. Okay. All right, so let's get into now the difference between the blockchain and smart contracts. All right, so the blockchain, like we discussed yesterday, is basically distributed ledger, and it's used more for financial transactions. It's a network basically built and maintained by distributed computers running specific pieces of software. Blockchains comprise a digital and distributed ledger that track monetary transactions. So it's a distributed ledger that tracks monetary transactions. So the blockchain is more, we went over that yesterday a little bit about what the blockchain is and examples of how it's monitoring monetary transactions, and it's basically used for that. Many blockchain networks, they also utilize their own unique digital tokens as a way to transfer the value and transactions, which is like Bitcoin. When you add the transactions to the block, you create actually more Bitcoin, which is what they're referring to as far as sending, well, what I'm referring to as far as creating digital tokens as a way to transfer the value. And beside the fact that blockchains are decentralized and tend to process information more quickly than traditional ledger technologies, transferring the value with digital tokens isn't all that useful. So there's not a lot of value in being able to keep track of financial transactions, and that's not the main reason why cryptocurrency or blockchain has become such a wonder at the moment, or such a new thing, or such a new fortune at the moment. And the main thing that is becoming more intriguing about the blockchain cryptocurrency world is the use of smart contracts. And I'm going to explain smart contracts as well, and the difference between blockchain and smart contracts. All right. So a smart contract is a software program that adds layers of information onto digital transactions being executed on a blockchain. It basically allows for more complex transactions than simply exchanging digital tokens for a product or service. In other words, it's exactly what it sounds like, a contract. It's a contract, an agreement between parties involved in a transaction that holds each party responsible, like a buyer versus seller, for example, for their role. Okay? So, with the smart contracts, it could be basically like receiving your next paycheck rather than wait to be paid every 2 weeks or the last Friday of the calendar month. Let's imagine an employer that utilizes smart contracts in a blockchain could pay its employees every day or even every hour. And such a system would work exceptionally well for contractors in the quickly expanding gig economy. Think about like Uber or drivers or freelance programmers who suffer from lumpy project-based incomes. That said, not all smart contracts are created equally, and that matters greatly to cryptocurrency investors or people that's a part of the cryptocurrency space, okay? So, in all, blockchain would be basically keeping track of financial transactions, whereas smart contracts keep tracks of any transaction or agreement binding two parties on the blockchain. So this is the innovative figure of the blockchain, which is going to be basically used, I believe, for everything that we do nowadays that we have a middleman for, which is law, having notaries, in education, how they can keep all of your information all in one centralized ledger. A lot of different things as far as voting. Any transaction that is basically binding two parties is going to be on the smart contract, where when you adjust or change anything in the contract, everything goes null. So you can't adjust the smart contract without adjusting everything that was before it or everything that's above it. It's all confirmed on the smart contract. So that's the difference between blockchain and smart contract. They're literally pretty much the same thing, but the blockchain it tracks monetary transactions primarily, and a smart contract can basically track any type of agreement that binds two parties, and it's all on the blockchain. So that would be the main difference between blockchain and smart contracts, and that's what I believe would be the foreseeable future. The biggest thing that comes out of this space is the use of smart contracts in our everyday life, okay? All right. And we're going to go back to CoinMarketCap now that we know a little bit about smart contracts, to basically delve into how do we get these figures that we do see on CoinMarketCap, okay? And we see that the market capitalization. So we have the market cap, the price, the circulating supply, okay? And I'm going to go back to the notes one moment. So we have the price, circulating supply, and the market capitalization. And these are pretty much the most important things to look at as far as numbers wise when it comes to cryptocurrencies. Would be the price, the circulation supply, and the circulating supply. I'm sorry, let me erase that. The circulating supply, not the circulation supply. So the circulating supply, the market cap, and the price. And let's go back. We see the current price of Bitcoin is $6,382.55. And what happens is the price is basically deemed on the circulating supply and how much people want it. Or it's like with the price of anything, it's supply versus demand. So the price basically, let me see if they have a history of this where it began from the beginning, but I believe it started off its first exchange, it was on less than the 300th of a cent, about 0.0003. Let me see all. Alright, so the furthest they go is back to 2013, and that was at $135. So basically the increase in awareness of it over time, the use of it, and the basic demand of Bitcoin drives the price. And now that you see how the price is created, you want to probably know how the market cap is created. Now the market cap is created by the circulating supply versus the price. So however many are in circulation times the price, that is the market cap of the entire coin. So with all of these, it's 102 million Ethereums left. 102 million Ethereum times 198 would get you that market cap. Same with XRP. There's 40, what is this, billion of these, and this is 45 cents. 40 billion times 45 cents will get you that, 18 million. So that's how you get the market cap, is multiplying the circulating supply versus the price. So let me see. Scarcity times demand. So the price is created with how scarce it is, and that is basically weighed also with the demand, is how the price is created. So the smaller the amount of the circulating supply, the higher the price of the coin. The higher the circulating supply, the lower the price of the coin. And the circulating supply is the amount of coins in circulation. Circulation. And the market cap is the price times the circulating supply. And there's also a max supply. Before I forget, the max supply is the maximum amount of coins that they're allowed to create. So let me see. Let me erase this. One moment, typo. and this is the maximum amount of coins able to be pushed into circulation. So a lot of coins are not mined yet, which is a part of the max supply. So let me just go back to coin market cap, so we can take a look at, let's go for Bitcoin for example. You see the max supply is 21 million, but there are only 17 million right now circulating, so there's still around 4 million left to be mined, and that's what they were saying weren't going to be fully mined until the year 2140, because they're basically mined on the blockchain. It's a time thing. It's not anything to do. You can't inflate cryptocurrency. So no matter how big the demand of cryptocurrency or Bitcoin per se gets, there will only be this amount in supply until the miners create more. And actually, there's a rumor that there's a couple million of Bitcoin that are just lost, and they're not actually being used as currency, which also pushes up the price, because it makes it more scarce, because there's so many Bitcoin that are just away, not being used, that there's not that many being sold. So the demand being higher than the price of the sale is actually going to increase the price, because there's a high demand, but there's a very scarce amount of it. Okay. And that's going to be pretty much all today. Our next class, we're going to go and teach you guys how to purchase Bitcoin and cryptocurrencies, and how to basically get them onto the exchanges, and also how to manage your wallet, your private keys for altcoins, and more into the technical aspect of buying, holding, and selling cryptocurrency. So I want to thank you guys for taking time out to look at RIFL Corp's Blockchain University. My name is Andre Rivers, and I'll see you on our next session.